Hi, it's Brian Decker with your Market Minute. I want to talk to you about something that's kind of interesting. Since 1947, corporate earnings per share have grown around 7.72%, while the economy has expanded by 6.4% annually. Those two have to grow together. When they deviate, there is a reckoning where things come back together. Over the last 15 years, stock market returns have run well above the long-term average of around 8%, while the economy was running well below the 6.4% rate. Here's the issue. Total stock market returns are a function of corporate earnings, which is GDP, plus Fed influence and stock buybacks. Such was the case from 1948 to 2000. However, since 2008, GDP growth or corporate earnings have averaged roughly 5%, yet stock returns have far surpassed what the economy can generate in earnings. As we head into 2025, let's review what drove those outsized returns in the last 15 years. There's two things. Remember, stocks cannot indefinitely grow faster than the economy over the long periods. When the stocks do deviate from the underlying economy, let's look and see what it was the difference, and then see if that will continue. So there were two differences in the last 15 years. The first is corporate stock buybacks. Refer to the chart here in this plan. You see that stock buybacks have gone way up since 2012. The second is monetary and fiscal Fed intervention, unprecedented since the financial crisis. Since 2007, the Federal Reserve and the government have continuously injected roughly $40 trillion in liquidity into the financial system and the economy to support growth. However, the last 2 years, the Fed has reduced its balance sheet and lifted rates. Stocks still climbed on expectations that the Fed would eventually reverse course. This deviation from long-term growth trends is unsustainable, which is why we have focused on momentum strategy. While the markets may go down in 2000, 01, and 02, for example, S&P was down 50%, Nas down 70%. There were many sectors of the markets that momentum would have invested in, anything going higher, which was real estate through the REITs, gold, silver, energy, pharmaceutical, biotech, healthcare. All those were making money while the stocks got creamed. So this is why we put together the two-sided strategy. We're hoping for the best, that stocks continue to go higher, but we're planning for the worst, and that is this trend in the market is unsustainable based on what the Fed is doing, corporate earnings, and the US GDP. So it's Brian Decker. Hope you have a good week.